So let's look here. So we've got a purchase of $500,000, which is 40%. We know that the assets were $1.4 million, liabilities of $500,000, which really makes the book value $900,000. The net assets $900,000. It tells us we know there's a building that's undervalued by $140,000. And we have a trademark that's undervalued by $210,000. We have to take into account the income and the dividends paid out. So how are we going to construct this? Let's go back to how we initially started it. We purchased $500,000, right? Now, the book value of the investee, of Johnson, is going to be $900,000 times 40%, right? Isn't it worth $900,000 for the book value? Do you see how it said the assets were, what did it say? 1.4 million, and the liabilities were?
Yeah, I was looking at it.
Okay, so we've got 900,000 times 40% is how much? 360. Right? Okay? Now, the difference, the cost in excess of book value is what? $140,000. How are we going to distribute that $140,000? It gave us two scenarios where a building was undervalued, or the book value was way under. So what is that going to be? What was undervalued? We had a building that was undervalued at $140,000, right? What's our share of that building? 40%? How much would that be? 66,000. I'm sorry, 56,000. And then we have a patent or a trademark that was worth how much? Or expected the value? 210, is it? So 210 at 40% would be what? $84,000, you said? So this difference, this extra $140,000, should be handled by these two differences. So here's the extra we paid over of $140,000 is identified in the building and the trademark. Now the building, what did they say the remaining life is? Only 7 years? So we have the remaining life. Here's it, it's at 7. What is the trademark, the remaining amortization at? 10. So if we take the building, our share, 56,000 divided by 7, right? 8,000 a year. And the trademark, this will be amortized over 10 years, which allots to $8,400 a year, right? How many of you guys are following me right now? Good. So we've got the allocation, what's shown as undervalued, payment identified as undervalued, and so our portion each year that we will amortize is 16,400. Do you see how we're coming up with that? So let's go back here. We've figured out what we purchased it for, the book value, we allocated the excess as an amortization. So now let's look at the investment purchase price was 500. The income for the year, income accrual, how much was their net income this year? Was net income of 90 and 40% of that. Gotcha. So 90,000 at 40% is 36,000. Then we have the amortization from over here, okay, of minus 16.4, right? What are the dividends? That were declared? 30,000 at 40%. Which would be a reduction of 12,000. So our investment in the company at the end of the year, should it be 5,076? Is that an good, B, 5,076. Should we take a break, or do we want to do number 9 and then take a break? Or have you had enough? Does it help to go over them? Let's just do one more, guys. We're on this same roll. So as you can see, if you can see, we continually do the same things. What we did from the first one we did to now is we have an excess in price over book value. And we're allocating it. That's the only change we've made. Okay? It still is being incorporated the same way. So number 9, Evan Company reports net income of $140,000 each year and declares an annual cash dividend of $50,000. The company holds net assets of $1,200,000 on January 1st. On that date, Shalina purchases 40% of the outstanding stock for $600,000, which gives it the ability to significantly influence Evan. At the purchase date, the excess of Shalina's $600,000 over its proportionate share of the book value was assigned to goodwill. On December 31st, what is the investment in Evan Company's equity method? What is the investment in Evan Company balance under the equity method and Shalina's financial records? Okay? So let's look at that. If we look here, Evan, net income 140, net assets of 1,200,000, and purchased it for 600,000. So let's start with the purchase price of the stock was what? Here, we'll start here. This is where we need to go. Just excuse me. Oops. I didn't want to do that. Clear. There. The purchase price of the stock was $600,000. What was the book value? Was $1,200,000 times 40%. What would that be? 480. Now the excess of cost over book value is actually going to be called goodwill. And that is going to be 120. And this goodwill of 120 doesn't get amortized. It's going to have an indefinite value or indefinite life. So this 120 is just going to be on the books. It's not like a patent where the life is limited. This goodwill is an intangible asset that we're going to keep on the books of 120. So there is no annual amortization on this 120. If we knew that the excess was a patent that had a useful life, but the goodwill, it's indefinite. So now let's look at how we determine the cost. Okay? So basically we gain from that there is an excess, but we're not going to take an annual amortization on that. So our cost on January 1st, 2014 is what? What is the 2014 income accrual? It was $140,000 at, what's the percentage ownership? 40%? So $140,000 at 40% shows our portion of that going into our investment account is $56,000. What about the dividend that happened in 2014? $50,000 at 40%. We can subtract from our investment, or $20,000. Then our 2015 income accrual was $140,000 also at 40%, or $56,000. Is that right? That sounds goofy. Each year, and declares dividends. Okay, I just want to make sure. So in 2015, we report our the same income and the same dividend. One increases the investment account, the other decreases the investment account. And we have to do the same in 2016. Same income all years. So in this one, 2016, 2016. Is there anything else we're missing? So at the end of 2016, our investment in Evan Company as of 12/31/2016 is at 708. What my goal is to help you see this information We add pieces, and we get comfortable with those pieces, and then we just add a little more, okay? But if you, in your head, keep it consistent, equity method, investment, calculate any difference over book value to see if anything needs to be amortized or reduced in the investment, okay? Add a portion of the income that we accrue each year, subtract any dividends. Bingo, okay? What we'll do throughout the chapter, we're just gonna add some more pieces in it, okay? That's all. So, let's take